Okay, so this is my second video on impediments to creating a properly functioning logical system. I would strongly encourage you to watch the first impediments part 1 and the explanation of a logical system before you watch this video. So again, impediments, there are three things that impede creating a properly functioning system. You have inconsistencies within the logical system. The statements are not consistent, or they contradict one another. You leave information out of the logical system. You leave a rule out, or you just make a logical error. You make a statement about a fact that's incorrect. Those are pretty straightforward, and they were covered in the first video. In this video, I want to talk mostly about extensions. But keep in mind that there are two ways that you can make your system incorrect. You can improperly use existing terms, associations, or assertions, or you can create extensions of terms, associations, and assertions that are improper. When you extend a taxonomy or extend a logical system, there are exactly four possibilities that you can do. You can create a more general idea or wider idea and put it in your extension. You can create a more specific idea, a narrower idea, and put it in your extension. You can create a similar, equivalent idea, or you can create a completely new idea. And controlling these extensions of terms, associations, and assertions, including the movement, the creator of the report moving around existing things, can cause systems to function improperly, and therefore these potential problems need to be controlled. So here is a specific thing that can go wrong. On the left, you see one representation of a breakdown of property, plant, and equipment, the subclassifications of property, plant, and equipment. On the right, you see a different representation. So both of these are proper. They're both valid under, say, US GAAP or IFRS, but they're different. They're completely different. Not completely different. The sub-classifications are different. If you look at the totals, property, plant, equipment, they're the same. Accumulated depreciation is the same, and the relationship between gross accumulated depreciation and net property, plant, equipment are the same. But the line items are the sub-classifications. The line items are different. In the one on the left, land is separated from buildings. On the one on the right, land and buildings are combined. So a more general concept, land and buildings, is created by economic entity B, and a more specific breakdown was provided by economic entity A. With regard to equipment, the opposite is occurring. Entity A provided a more general concept, equipment, and economic entity B broke out equipment into computer equipment and manufacturing equipment. So when an extension taxonomy is created, you need to be able to explain the relationship between the extension item created and something in the existing base taxonomy, so that the computer will know what the extension is. Now, you can argue the case that you know that, for example, the concept land and buildings that was created, you know that it is a type of property, plant, and equipment, because there's a calculation relation between land and buildings and property, plant, and equipment gross. You see that by the green value of the total, but that's the saying there's a calculation relationship. So you know that it's a type of property, plant, and equipment. I'm not sure if that's good enough, but XBRL, the calculation relations, the item or the summation item relations, kind of give you the information of a general special relationship. But XBRL also provides the mechanism for providing a general special relationship in the definition relations, and the ESMA has specifically provided a new type of arc-role relationship where you can provide a wider, narrower information about an extension concept. So anyway, that's all I'm going to say about this. But this is one of the things that can go wrong if you get this information correct, if you don't create these relations correctly. Another type of thing that can go wrong is, if you notice on the left, economic entity A, the two line items, additional long-term borrowings and repayment of long-term borrowings, roll up into the line item net cash flow from financing activities. On the right, those same two line items for economic entity B roll up under net cash flow from investing activities. Okay, so likewise, you can see that capital additions of property, plant, and equipment had likewise been reversed. So what's happening is economic entity A and economic entity B are totaling sub-line items with different subtotals. So an accountant would understand that the one on the left is correct. Borrowings and repayments of long-term debt are financing activities, not investing activities. But how do you control? The point is, how do you control when you have a taxonomy like the U.S. GAAP taxonomy has 14,000 concepts? How are you going to find the right concepts and get them under the right subtotals? So again, my point is that the associations between these concepts, the totals and the subtotals, you have to be able to control that, because that's the kind of thing that can go wrong. In this next example, I'm going to show you a contradiction. So there's a lot of moving pieces here, but I'll explain it. It's a really simple mistake that was made. Fundamentally, what happened is the company, and this is an actual SEC filing, a company reported a line item in a disclosure using the concept U.S. GAAP assets non-current, and they should have used the concept U.S. GAAP non-current assets. On the balance sheet, the concept assets non-current is used to represent the subtotal of non-current assets. In this financial statement, the economic entity did not provide the subtotal for total non-current assets. There's no subtotal. So they didn't provide that concept. However, they used the concept in a disclosure, you can see it here, incorrectly. So what they've done is they've used the wrong concept in in another disclosure, and that contradicts what the balance sheet is saying. So this is an example of a common thing that occurs. You have somebody use a concept in one disclosure that is intended for a different disclosure, and they use it incorrectly, and it contradicts the information provided elsewhere, and it is another thing that can make a financial report that is a logical system function improperly. Another thing that you can do is you can create a completely new structure. So here I used ipsum lorem text to make up some gibberish concepts, so there's no way that anyone could misinterpret and say that, oh yes, these exist. They don't exist. And you could create a new structure that is where either the subtotals are all new, but the grand total is something that exists, or the grand total is new and the subtotals is something that exists, or you could have something that where both the subtotals and the grand total don't exist. So when you create a completely new structure, if the structure relates to any of the elements of a financial statement defined in the conceptual framework, for example, you can see those for US GAAP, the elements of a financial statement on the right here, you should be able to associate either the line items or the grand total to one of these in some cases. In other cases, it's a completely new idea. Maybe someone is disclosing some non-financial information that is not required to be disclosed, so there's nothing in US GAAP, and there's nothing, it's not financial related, so it's not going to fit into any of these categories. So the point is that, again, you have to be able to control that within the logical system in order to get this right and assure that the logical system that is the financial report is properly functioning. So again, the point is to understand why things can go wrong. So I'm going to stop there for this video.